Democratic Senator Brian Schatz of Hawaii is expected to introduce a new tax bill today. In an interview with Vox Media last week, the senator said his bill would tax the sale of stocks, bonds, and derivatives at a 0.1% rate. That tax would be applied to any transaction that takes place in the United States or any transaction that a person in the U.S. makes. The senator said his proposal could raise nearly $800 billion over 10 years and would clamp down on speculation and some high-frequency trading that artificially creates more market volatility. The bill mirrors a similar proposal in the House from Congressman Peter DeFazio and Congresswoman Alexandria Ocasio-Cortez.
We've got a debate on this coming up later in the show. It's interesting reading into it.
Think?
If you just put purely on the surface, if it really is going to raise that much and it's a 0.01% tax, you're like, well, that's a lot better than many taxes there are across,
It just feels like we're getting into the point of where we'll tax anything.
Oh, sure. And also financial transaction tax do exist in other places, like in fact in the UK, I believe in France, and clearly.
Is it set up like that? Is it a 0.1%, or how does it work?
I don't know exactly, in fact, but they do exist elsewhere, and compared that to if it raises as much as increasing the wealth tax elsewhere, I think it sounds more appealing in a relative sense. But I also get the negative downsides of it that.
I'm not a fan of adding taxes like this. The one thing that sounds slightly appealing is the idea of cutting down on some of the trading just for trading's sake.
Well, the only type of trading it would really make a difference for, in a big way, is electronic, automated, very high volume trading.
That's interesting.
And I think you would have to look at exactly how many fees there are, the exchange fees and SEC fees already on every transaction to see how this compares to 0.1% on top of all that. But I also think trading can be sent elsewhere. I mean, you can always find another venue, another location to do it.
If capital's treated better.
It's not as if you can count on that $800 billion over 10 years.
Yeah, so I'm sure the exchanges would not be a big fan
of
that.
Not at all. No.
They'd be opposed to every...
The other point behind this, of course, which is a theme that sort of comes out with some of the progressive candidates' proposals for increasing tax on the wealthy, which is that the people that predominantly hold stocks do tend to be more wealthy, and this is the people that it would fall on. And again, if you just snapshot the last decade or so, there is a slightly bigger reason to pursue that in a way than in the past because of QE, which was a huge stimulus and largely benefited the people that already had stocks and financial assets as opposed to Main Street. And so there's a slightly elevated case today than at any point in the last sort of 50 years to go after that sort of area as opposed to...
That's why you hear the noise about it, for sure.
But also, I'd be interested to hear how an operator of an index fund, an ETF, that is doing nothing but trying to lower fees for management fees, how this would affect their ability to do that.
Right, when you have to trade on a daily basis just to mirror the index. Right, and those tend to not be the wealthier people. Those tend to be the people who are just watching at home. Right, that's the Main Street reflection of what happens on Wall Street.
Yeah, I mean, and the other point is to make it even more appealing in a relative sense is who does it fall on to? You could structure it such that it's not the buyer, not the seller of the stock, but the broker. And then it's more of a Wall Street tax.
Although that always gets passed on, to the consumer.
That's true.
They try.
They try.